Welcome back. The number of people submitting mortgage applications increased to a 5-week high given the fact that rates overall have been decreasing. However, though, the amount of people submitting loan applications still remains at extremely low levels. In today's video, I'll share this brand new report from the MBA, but also have an update for you guys regarding mortgage rates today as well, because there's some very big changes to say the least here. With that said, let's begin today's video. And also, if you guys are new here, I invite you to subscribe to this channel right now because I post frequent housing market updates so you guys can be more informed about our US housing market. And of course, with that said, I appreciate you, and let's begin today's video. So this first report I want to share with you guys was just announced today, which is November 15th here. This is actually from the MBA. They look at applications overall for refis, but also for purchases as well. This covers around 75% of all applications for home loans. So mortgage applications increased by 2.8% compared to 1 week ago. This report covers the week ended November 10th this year. So they look at the refi index as well as the seasonally adjusted purchase index. So the refi index increased by 2% from last week, and also it was 7% higher compared to 12 months ago. Meanwhile, the seasonally adjusted purchase index, a measure of the amount of people submitting loan applications to buy houses, increased 3% from 1 week earlier. It still remains 12% lower compared to 12 months ago. And I'll have some data to share how the levels right now compares to years past, going back to the year of 1995. According to Joel Kahn, who's the MBA's vice president and deputy chief economist, he stated the following. Although treasury rates dipped midweek, mortgage rates were little change on average for the whole week. That was last week. The 30-year fixed rate remained at 7.61%, about 30 basis points lower than 3 weeks ago. He says both purchase and refinance applications increased to the highest weekly pace in 5 weeks, but of course remains at very low levels. So based on my analysis of their data here, except for the previous week, the purchase index hasn't been this low since February of 1995. So in other words, the amount of people submitting applications to buy houses is very close to a 29-year low. Also, when looking at levels back in late 2019, we're down by about 50% as well. And according to Joel Kahn, despite the recent downward trend, rates at the current levels are still challenging for many prospective homebuyers and current homeowners. So have a look at this, because here's a look at their purchase index over the past 5 years. So their index right now is 129. The previous week was at 125.2. So when looking at pre-pandemic levels back in 2019, back then the index was around 260. Now it's about 50% below current levels. Also, when looking at the change in the index going back to the year of 1995, the index right now, except for the previous week, is on par with the lowest levels going back to the end of February of 1995. So in other words, we have very low levels of people submitting loan applications right now due to historically low levels of existing houses for sale, but also due to the fact that home prices and of course mortgage rates still remain very much elevated right now. Now going back to the MBA's report here, here's something that really shocked me as well, because the share of refinance applications is at 31.9%, an increase from the previous week at 31.4%. So 3 of every 10 applications for home loans is for a refi, which is absolutely crazy because we're very close to multi-decade highs for rates. On top of that, as I reported to you guys about a week ago, approximately 90% of people doing a refinance right now are doing a cash out refinance and getting a higher rate, which is abnormal because Normally, when people do a refi, they could be getting cash out, but for the most part, people doing a refinance are getting a lower rate. Otherwise, what's the point of doing a refi? So the reason why people are doing cash out refinances right now is due to financial hardships and, of course, our softening of our labor market we're seeing right now. The MBA also reported here that the ARM share of activity decreased to 8.8% of all applications. The reason why this number has been relatively high over the past couple of weeks here, though, is because the spread between a 30-year fixed rate mortgage and a 5/1 ARM, for example, in which your rate is fixed for 5 years, then it becomes variable thereafter, a more risky loan product, is because the spread has been growing here. So right now, at least for last week, the average 30-year fix for loan balances less than $726,200 was at 7.61%. For a 5/1 ARM though, it's only at 6.65%. So some people are moving to get an adjustable rate mortgage because, of course, the interest rate is quite a bit lower compared to a 30-year fix. Now, speaking of rates, here's the average rate today, which again is November 15th for people with great credit. According to Investopedia.com, for the average 30-year fix, that's at 7.77%. Now, something to keep in mind is the average rate for people doing a refinance is actually quite a bit higher. So 7.77% for a purchase overall, again, for people with great credit, a FICO score over 700, and of course, a loan to value ratio of at least 80%. So if you're buying a house, you're putting down at least 20% down. Compare this to rates for a refinance though, that's at 8.16%. Also, when looking at daily rates, according to the Mortgage News Daily, that's at 7.45%, an increase of 5 basis points compared to yesterday, despite a new inflation report that showed inflation for producers came in cooler than what was expected. And I'll share that with you guys here in a little bit. Jumbo is at 7.84%. FHA and VA is around 6.77%. 1 year ago, we were looking at a 30-year fix at 6.61%. This means that average rates have increased by about 84 basis points compared to 12 months ago. Now, the reason why rates increased today is a little bit mixed, or I should say based on mixed news regarding our US economy here. So here's a look at the US Treasury note. That increased by about 9 basis points today to about 4.53%. As CNBC reported here, Treasury yields increase, that a rise of 9 basis points, despite another report that shows inflation is actually falling. So on Tuesday, the CPI, or the Consumer Price Index, a key measure of inflation that the Fed looks at, came in much cooler than what was forecasted. Now, here's what happened today as well. Because the Producer Price Index, or the PPI, also came in lower than what was forecasted as well. So inflation is coming down on the consumer side, the CPI, but also based on inflation that producers are paying as well. So core PPI, which excludes volatile energy and food prices, on a month-to-month basis was flat. The forecast was a gain of 0.3%. And also in September, we saw a gain of 0.2%. Also, when looking at the rate compared to 1 year ago, we saw an increase of 2.4% versus the forecast of 2.7%. Also in September, the rate was at 2.7%. So core PPI month to month as well as year over year came in below expectations, but also below September's levels as well. Meanwhile, headline PPI, which includes volatile gas and food prices, decreased by 0.5% compared to September. The forecast was an increase of 0.1%. And also in September, we saw a gain of 0.4%. So this decrease of 0.5% was catching people by surprise here, because that was the biggest monthly decrease since April of 2020. Headline PPI also came in below expectations on a year-over-year basis and also below September's levels as well. Like I mentioned, despite this cooler than expected inflation report here, Treasury yields actually increased today, which caused mortgage rates to increase. One of the reasons why we could have seen yields increase today is due to this right here. So retail sales on a national level increased by 0.1%. The forecast was a decrease of 0.2%. So it came in higher than what was forecast here. That, by the way, I should say, was core retail sales, which excludes automobile sales here. That increased by 0.1%. In contrast, when looking at retail sales, including auto sales, that decreased by 0.1%. The forecast was a decrease of 0.3%. On top of that, retail sales, excluding gas and autos, rose by 0.1%. The forecast was flat. So it came in above expectations as well. So big picture here, it appears that investors kind of shrugged off this cooler than what was expected PPI report because retail sales came in stronger than what was forecasted nationwide here. So please leave a comment below with your biggest takeaways from today's video. Also, if you guys got any value out of this video whatsoever, then please hit the like button. Of course, appreciate that. Of course, appreciate you. Hope you guys have an awesome day. Like and subscribe, and we'll see you on the next video.